Is Nvidia, after an incredible run of the last 5 years with over 2000% of gain, still a buy? That will we find out in this video. And with that, welcome back to Investing for Generations, your channel for high quality stock research for long-term value investors. And today I want to talk about Nvidia, a very big company in the chip sector. And Nvidia designs graphics processing units for the gaming and professional markets, as well as system on the chip units for the mobile computing and automotive market. And its primary GPU or graphic processing unit is GeForce. And you find GeForce especially in the gaming computer, but also in professional computer. And so I want to go through these points of Nvidia. First of all, I want to talk a little bit about the company, then about the financials, then come to a price valuation, and the conclusion if Nvidia is a good buy for a long-term value investor right now. And at last, I want to give you my weekly portfolio insight. So let's go. First of all, they produce graphic processor units, and this is also the main of their revenue. As you can see here, the GPU sector is by far the biggest of the revenue of Nvidia. Overall, Nvidia right now have a revenue of over $11 billion per year. And mainly they produce their chip units for the gaming sector and also the professional sector, and their market share in the GPU sector is incredible high at 80%, so they are the market leader in this sector by far. And with this good market position, of course, they can earn a lot of money. And with that, just take a look at the financial numbers of Nvidia. The revenue of Nvidia over the last 5 years just explode from 4.78 billion to now over $13 billion. This is an immense growth rate and in a market which still is growing a lot. And with this growth of revenue, also the earnings per share grew from $0.95 in 2015 to now $5.44. And this is also incredible high growth rate. And as a lot of these companies in the tech sector, they work on very high margins with an operating margin of over 27% and a net margin of almost 26%. This is just a cash machine, and so an incredible good business model, and so far a great company. And what's even better, their debt equity ratio is at just 0.5, which just means the equity is double the long-term debt, even if the long-term debt lately just rises a lot. But with this low interest rates right now, this is not a big issue. And as I said, a debt equity ratio of 0.5 is just great. And next to this, they have almost 11 billion of cash in hand. So they are also in a very, very good position to invest in growth. And so their financial position overall is just great. And also when we look at the free cash flow, this is just a wonderful picture for a value investor like I am, because the cash flow just come in and rises over time. So this is really great. A very, very profitable business over the last 5 years, and also the free cash flow just grew over the past. So overall, the financial numbers are amazing, and we have here a great, great business with a very good market position in a growing market, so almost perfect. But what's about the price? To calculate the intrinsic value of a stock, we need, first of all, the expected growth rate, and per Yahoo Finance, the estimated growth rate for the next 5 years is 17.44%. And this is not like the past 5 years, which an incredible growth rate of 52%, but 17% over the next 5 years. It's still a great number. And the other thing we need to calculate the intrinsic value is the earnings per share, and the earnings per share, or EPS, we can see it here for the trailing 12 months. So for the last 12 months is $5.44. And these are the two numbers we need to calculate the intrinsic value. And if we put these numbers into the calculator, so the growth rate of 17%, we took it here for the first 10 years in our calculation, and then for the second 10 years, we take a terminal growth rate of 12%, and our expected return or discount rate of 12%, then we come to an intrinsic value of $153 compared to a current price of $511. It seems like Nvidia is overvalued by over 200%, so massively overvalued. And even if it's a great business, you know already that even the best business, it's not worth buying if it's way overvalued. Just to give you an idea how much this is overvalued, I also calculated how much has to be the growth rate for the future just to come to a fair value of these $511 we have right now. And if you calculate this, you come to a growth rate for the next 10 years of 33% per year, and determine a growth rate for the next 10 years of 15%, and then you come almost to the current price. And then just think about if this is realistic. Is it realistic that even the best company grow for another 10 years with 33% per year, and then for another 10 years for 15%? I don't know. For me, I can't imagine this. I think this is not realistic. Or you can also put this the other way around, and you can say, okay, if we have a current price of $511 and we take the 17% of growth rate for the next 10 years and 12% for the second 10 years, how big would be our return from the current price? And then you come to a expected return or discount rate of 1.8%. And of course, 1.8% is still better than the current bond rate or the current interest rate. So it could be even better to buy into Nvidia at these high prices with a better return than if you buy bonds. But expected return of 1.8% is not the return I like. And even the 17% growth rate for the next 10 years and 12% for the terminal growth rate, it's still a lot, because no business in the world grow in double digits forever. And so even with this calculation, this is an optimistic calculation in my mind. So my result of the analysis of Nvidia is that of course we have a great business with a great business model, a cash cow, a lot of market shares, and in a growing market. But on the other hand, the price is way too high compared to the value. Nvidia is not a buy for me right now as a long-term value investor. And don't get me wrong, this is just a calculation, and this is about the theory that the stock price every time comes back to the intrinsic value, and the intrinsic value is just the earnings for the future. This doesn't mean that Nvidia can even double again in the next 12 months. It just means that somewhere in the future, in the next 10, 20, 30 years, this stock will come back to the intrinsic value. Nobody can predict the market. Nobody knows if this, but it will happen at one point. And so Nvidia is nothing for me because I'm not a trader. I'm a long-term value investor. I buy my shares and hopefully have never to sell again these shares, or just sell it when they are way overvalued again. This is my point of view, and for me, Nvidia right now It's just too pricey. Then take a look at my portfolio. First of all, I got my dividend of Chevron last week of $36.18, which is nice. And of course, Chevron as a good dividend payer, this is a high dividend for the quarterly dividend. And then also take a look at all of the positions in my portfolio. And as you can see, it's still very, very green. Just Wells Fargo and Imperial Oil, which had kind of problem lately with their pipelines, is in the red. The rest is in the green and way up in the green foremost. And so I'm very happy with this performance. And of course, you can find a deeper analysis of every of these stocks on my channel, and there you find analysis of the businesses and also an analysis of the valuation and the calculation of the intrinsic value of every of these businesses. And last but not least, just take a look at the overall performance of my portfolio compared to the S&P 500. And therefore, I have a performance of a little bit over 25% since the 2nd of December when I started this North American portfolio. And this is an outperformance to the S&P 500 of a little bit over 15%. And this is nice. I'm very happy about this. We will see how this will go on. And just follow me on my way here to financial freedom. And if you like the video and if you find some value out of this video, just give me a big thumbs up and subscribe to the channel, and just stick with me on this way to financial freedom, and you will get 1 or 2 videos a week with a deeper analysis of one of a great business. And so we will find great businesses and hopefully also businesses on a reasonable price. Right now, this is difficult because the market is very high and overall overvalued. So it's difficult to find great businesses to a reasonable price. But we have to stay patient, and of course, it's possible to find these businesses. And if you take a deeper look on the analysis of the stocks in my portfolio, you will find businesses under or around the intrinsic value. So check this out. And that's it for today. If you liked the video, give me a big thumbs up, subscribe to the channel and ring the notification bell. And then we will see you the next time with another analysis of another stock out of my watch list. See you then. Take care. Bye bye.